A lot of times gold, right? Gold mining is a risky business. Sometimes something happens and you can't quite produce as much as you thought because there was a problem at a mine. I never care. I don't care if a gold company wasn't able to pull some gold out of the ground in a particular quarter because of some delay. Because all that means is the gold is still there. They're still going to sell it. They'll just sell it later. They don't lose it. It's not going to go bad. It's still in the ground. And in fact, the longer they wait to pull it out, the more money they're going to get. Before I do, I wanted to talk again about the reaction because gold was up $100 an ounce after being up $90 an ounce on Monday. So you had a $190 two-day move. And now we had a $70 pullback today. But the trend is clearly up. And I think what sparked the pullback was the optimism about trade talks with China.
Peter Schiff's bold prediction about the economy and the future of precious metals are generating news once more. Schiff, the longtime supporter of sound money and CEO of Euro-Pacific Asset Management, is raising the alarm more loudly than ever as the world's markets struggle with inflation, growing debt, and depreciating currencies. He thinks that most investors are unaware of how vulnerable the current state of the economy is, and that a significant correction is not only possible, but also likely. Schiff claims that people who ignore these early indicators could be caught off guard, since the recent surge in gold is only the start of a far bigger rally. Schiff contends that the Fed is caught between raising rates without starting a crisis and cutting without starting inflation again, while conventional commentators continue to minimize the hazards of inflation and money printing. He thinks that this no-win situation will encourage investors to seek refuge in genuine assets like gold and eventually silver. Please remember to like this video, subscribe to the channel, and enable post notifications before we delve further. Thank you and enjoy the video.
The sleeper fund on the year is the emerging market fund. I think it's only up 5 or 6%, but I think the emerging markets ultimately have the most to gain from the dollar's demise. They've been sharing the lion's share of the burden. In fact, our emerging market fund is overweight China, and for the reasons that I've spoke, there's a lot of pessimism on China, and that means there's a lot of value in China. You always want to invest where there's pessimism. If you're just investing where there's optimism, you're going to overpay. The best chance you have of getting a good deal is, going where people are afraid to venture, going where people are saying everything is bad, because then what can happen? Stuff can be good, right? If everything is priced for perfection, if everybody already thinks everything is great, well, then the only thing that can happen is it's not as great as people think. So China is very fertile ground and we're overweighted. So if you have a hard time figuring out, what Chinese companies to buy, solution is just buy my emerging market fund and you'll get exposure to China and you'll get exposure to other markets. The gold stocks continue to be ridiculously cheap. The earnings came out earlier this week. Kinross beat earnings quite a bit, actually rose for a change. Barrick Gold also beat earnings today. Initially, the stock was down, but it ended up positive on the day. That stock is ridiculously cheap. The one that missed was IM Gold, and it was down about 5%. But it's not going to miss for the year. A lot of times gold, right? Gold mining is a risky business. Sometimes something happens and you can't quite produce as much as you thought because there was a problem at a mine. I never care. I don't care if a gold company wasn't able to pull some gold out of the ground in a particular quarter because of some delay. Because all that means is the gold is still there. They're still going to sell it. They'll just sell it later. They don't lose it. It's not going to go bad. It's still in the ground. And in fact, the longer they wait to pull it out, the more money they're going to get. So the fact that they produced a little less during the quarter just means they're going to produce more in a later quarter, and they're going to get even more money for the gold because the gold is going to be higher in price. So look, these gold stocks are still ridiculously cheap. Even though they're up quite a bit on the year, they're not up nearly as much as they should. And they were ridiculously cheap when the year started because they never should have sold off in the fourth quarter of last year. So you still got a great buy on the Euro-Pacific Gold Fund, EPGIX. I now know the symbol. People were always making fun of me. I kept getting the symbol wrong on the podcast. EPGIX is the no load. And all of my funds have a no load version. The value fund, the dividend payer fund, the emerging market fund, my foreign bond fund, all those funds can be bought at any discount broker, no load. And if you want to get the physical, look, Schiff Gold, I prefer silver right now. I mean, silver still can't move. And in fact, I think Goldman Sachs just did a report and they said, don't expect silver to go up because the central banks aren't buying it. They're only buying gold. That's probably a great buy signal when you get a big bank like Goldman Sachs telling you not to buy silver. It's probably because they want to buy it themselves and they don't want competition. So I do think any day, it's the proverbial coiled spring. At some point, silver is just going to explode. So you can go to Schiff Gold and buy yourself some silver. I think silver's got the same type of upside potential, actually, as the gold mining stocks. Now, the silver mining stocks, that might even be one better than the gold mining stocks because they're really depressed because of how depressed silver has been. Before I do, I wanted to talk again about the reaction because gold was up $100 an ounce yesterday after being up $90 an ounce on Monday. So you had a $190 two-day move, and now we had a $70 pullback today. But the trend is clearly up, and I think what sparked the pullback was the optimism about trade talks with China.
Although there was a slight rise in the value of the US dollar, Peter Schiff recently noted that the movement was unexpectedly small. Many anticipated that the dollar would rise more precipitously given the Federal Reserve's cautious stance. This ambivalent response, according to Schiff, might indicate that the dollar is intrinsically weak or that the markets haven't properly received Jerome Powell's message. Gold is demonstrating genuine strength at the same time. Gold prices have remained stable over $3,350 per ounce, despite better-than-expected job market data that would often put pressure on them. As more investors look to gold for stability in an uncertain economy, this demonstrates exactly how resilient gold has become. Looking at what's going on the COMEX makes that demand even more apparent. The number of new contracts for physical gold has skyrocketed since the May gold contract's delivery term began. 6,712 new contracts have been created in just 6 days, which is significantly more than the 1,525 historical average, and even surpasses the 4,150 previous record. Don't forget to subscribe and hit the bell icon to stay updated on our latest videos. We'd love to hear your thoughts in the comments. Now let's dive back into the interview.
I'm actually surprised that gold didn't sell off more than it did. It was down about $70 on the day, but it was already down about $40 or $50 before the press conference. So it wasn't that big a sell-off. In fact, GLD yesterday closed, I think 2 or 3 cents below its record high close from a couple of weeks ago. So for all intent and purpose, it was at a record high yesterday. And, so it didn't really come down that much given how hawkish I believe the Fed was. And the dollar rallied, but, it wasn't that big a rally given this. So I don't know if it really shows how weak the dollar is and how strong gold is that, both markets shrugged off this hawkish Fed, or maybe the markets, haven't really connected the dots to what Powell just said. Maybe it's going to take a day to set in, and then we're going to start to see a bigger reaction. The final thing that Powell said that I thought was really ridiculous at the press conference and really shows you, maybe he is that clueless when it comes to, basic economics. And I've always thought, like, in order to get a job at the Federal Reserve, you got to flunk a test in basic economics, right? Only the people that fail the test, right, get to work at the Fed. If you pass the test. A question he got had to do with, isn't he concerned about supply shortages coming from the tariffs? Because, all the ships that normally bring Chinese goods to port, they're not showing up, or they're showing up half empty. And so there's not going to be enough goods, right? It's another COVID style supply shock. Only this time it's not the pandemic, it's the tariffs. And he said, well, he's not really thinking about that, or, he doesn't seem to think that it's material. And I think the reporter said, well, would you do anything? Like, how would you respond to this, right? And Powell's answer was, well, it's beyond our mandate, because he said our policy tools only affect demand. He said we can't do anything about supply. And so, that's going to be up to the Congress to get involved. We just have no role. And of course, he's completely wrong. Maybe Powell doesn't understand supply and demand, again, which proves that he flunked the test on economics in order to get the job at the Fed, because he absolutely can have an impact on supply, because supply and demand work together. So if there is a supply shortage, what Powell's job is to address that from the demand side. So if supply goes down, the Fed needs demand to go down, right? That way the market stays in an equilibrium, right? So if there's less supply, okay, well, let's have less demand. Powell absolutely can address that. So what would be the appropriate response if all of a sudden there were a lot less goods for consumers to buy? Well, Powell needs to tighten up on the money supply, raise interest rates to reduce demand so that demand comes down along with supply. That's what he should do. But of course, he's never going to do that. He's not going to hike rates. He's not going to reduce demand. That crash the economy. But that's really what the Fed's supposed to do. In fact, I mentioned this on the podcast. When the Federal Reserve was first created in 1913, that was precisely what it was supposed to do. It was supposed to have an elastic money supply that expanded and contracted along with the economy. So if the economy was booming and there was excess supply, the Fed was supposed to allow money supply to grow. But if the economy was contracting, if supply was going down, the Fed was supposed to suck that liquidity out so that money supply came down with the supply of goods. So to keep the two, in harmony. So Powell absolutely has the ability to react to changes in supply by changing demand and then changing where the supply and demand curves intersect. So he doesn't even understand how monetary policy works or how supply and demand, right? This is the most basic laws of economics, the interplay between supply and demand and how one affects the other.
In reaction to the Federal Reserve's latest press conference, Peter Schiff said he was surprised that gold didn't drop more precipitously. He noted that although gold fell roughly $70 during the day, the majority of that drop had already occurred before to the Fed's statement. Schiff anticipated a larger surge in the U.S. currency and a more robust sell-off in gold due to Jerome Powell's aggressive tone. However, that did not occur. Schiff continued by criticizing Powell's answer to a query concerning tariffs and the possibility that they could result in supply shortages. The Fed only addresses demand, not supply, Powell said, dismissing the matter. In stark contrast, Schiff contended that the Fed can indirectly affect supply-side problems by modifying demand through monetary policy and interest rate adjustments. In order to maintain market equilibrium, he clarified, demand should likewise be decreased when supply declines. In such circumstances, he argued, the Fed should tighten monetary policy because that is plain economics. Schiff, however, doesn't think Powell would do that since rate hikes could force the economy to collapse. He also underlined how, in spite of recent volatility, gold has held up well. Schiff thinks that increased optimism regarding U.S.-China trade talks rather than underlying weakness is what caused gold to drop $70 after rising over $190 over 2 days. He claims that the general trend remains positive for gold. Don't forget to like, subscribe, and enable notifications for more valuable content, and as always, happy investing.